Hello, there are several books, blogs, and other tools that can help you manage your money better. But your busy schedule may have kept you from focusing on this important aspect of your life. Through this 10-minute video, I am going to share my understanding at a very basic level. For more, you can explore these resources in detail. Let's start with this timeline of our life. Sometime in our 20s, we start earning and become independent. We continue to work until retirement around the age of 55 to 70. The life expectancy of an upper class Indian is about 80 years and possibly more. That gives us about 2 years of working life for every 1 year of retirement. Unless your ancestors left you with a fortune, you will need to create it so that you can spend it during retirement. Keeping all else equal, this means that you need to save a third of your income during 40 productive years and spend it during 20 retired years. Now, do you even know how much you are spending every month or year and how much is saved? If you are anything like me in my 20s, you wouldn't have thought about this at all. Here is how you should visualize your expenses and savings. Historical statements of your bank accounts and credit cards should be helpful in estimating your savings. Going forward, you should plan every expense and spend only if it is planned, particularly these high value items. That is basic financial discipline. Once you put the house in order by planning the finances, the other big decision is where to invest your money. For a salaried person, about 10% of income is compulsorily deposited in the employee provident fund. You may be investing another 5% to save taxes, etc. That leaves about 18% amount that you need to choose where to invest. I have listed typical avenues here. If all your wealth is white money, then mutual funds, shares, and other securities are recommended options for investment. There are a few things one needs to consider while choosing where to invest. Number one is ROI, number two, risk, number three, liquidity, and number four, diversification. We will see each one in detail. Through this table, I am trying to show the role played by years of investment and rate of return. The table shows how an investment of 1 lakh would grow. At 8% per annum, it would be 1 lakh 8,000 after a year. Due to compounding, it becomes 1 lakh 47,000 after 5 years, a little over 3 lakhs after 15 years, and 10 lakhs after 30 years. At 10% and 12%, it grows even faster. At 12%, your 1 lakh would go to 5.5 lakhs in 15 years and 30 lakhs in 30 years. The difference is huge, as seen from the graph below. You would have also heard your relatives say that a plot of land was purchased at about 50,000 rupees in 1995 and today it is worth 20 lakhs. That's known as the power of compounding. That is why the gold price was 500 rupees when I was born, 5,000 when I was 25, and 50,000 today. So not only does the rate of return matter, but also the duration of your investment. And therefore, it is important to start saving at an early age. Famous investor Warren Buffett started saving before he was 15 years old. The money came from delivering newspaper, magazines, chewing gum, and Coca-Cola. Now, before you get excited about high returns, let me also caution you about the risk it carries. This chart shows the growth in investments made in American stocks and US government bonds, which are similar to fixed deposits. As you can see, the stocks grew from $100 to about 6 lakh in 92 years at about 10% per annum, whereas the bonds grew to $9,000 at a more modest 5% rate. I bet you also see that the growth in bonds is steady, whereas the stocks are bumpy, that give flat or even negative returns for many consecutive years. So higher returns usually also come with higher risks. In this slide, I am giving some examples of safe investments and riskier investments. You must have heard of Provident Fund, fixed deposit, postal savings, but probably not about PPF because nobody gets a commission for selling it. However, everyone must have this account through their banks. It can be opened online. On the risky side, we have gold, property, shares, mutual funds, etc. Now, I'm going to not going to suggest what is the best investment out of these, but you must put some of your savings into safe investments, giving a stable and guaranteed return, and some in risky investments, giving volatile returns. There is a rule of thumb based on your age. If your age is 30, then about 30% of your savings should be in safe assets and the remaining 70 in risky assets. Next, we look at how liquid your investments are. On one hand, we have cash or gold that can be used in place of cash at any hour of the day. And on the other extreme, we have real estate that cannot be sold in a few weeks or even months. And some government control instruments that cannot be encashed for many, many years. It is important to note how liquid all your wealth is so that it is useful during emergencies. Financial advisors recommend keeping at least 6 months expenses in liquid instruments like savings account and fixed deposits that you can encash when needed. We look at diversification. On the left side, you see a portfolio that is concentrated on just two investments, a property and bank deposits. This is risky because your whole future is tied to the fate of property market in your locality. In recent years, many of my friends have realized that putting all eggs in one basket is not a wise decision. Instead, one should keep investments in a variety of instruments as shown in this pie chart on the right hand side. Finance textbooks explain how variety reduces risk. Google about modern portfolio theory by Harry Markowitz for details. That brings us back to the question of where to invest your money. If you remember, you should be saving 33% of your income, about 15% gets deducted for PF, etc., which are both safe and illiquid investments. The remaining 18% should be invested by balancing ROI, risk, liquidity, and diversification. You could keep about 2 to 3% in safe liquid funds such as fixed deposits or preferably debt mutual funds. At least 10% of your salary should be invested in equity mutual funds every month because at this age you can afford to take the risk. If the number of mutual funds is too confusing, then I recommend choosing any large cap or mid cap index fund from a reputed seller, such as SBI mutual fund. Investments into traditional avenues, gold and real estate, should not be more than 10% of your salary and be electronic rather than physical. I'll close this video with some practical advice about tax planning. First of all, you must recognize that you pay a huge amount of taxes on income and consumption. Often the taxes paid in a year are more than your monthly take-home salary. So shouldn't you spend a day to work out whether you can legally escape from taxes? Or think whether the instrument sold by your relative or friend was the right one for you. I have listed some commonly missold products on the right hand side that you should stop putting money in. The options listed on the left should be considered instead. Wish you all the best.